But as promised, let's get chatting with the management of CAMS. Their Q4 performance was a little bit lower than what some were estimating on the street. What's the outlook from here on, and how do you see business shaping up? Well, we're joined by Mr. Anuj Kumar, the Managing Director and the CEO at CAMS. Hi, Mr. Kumar. Good morning, and thanks a lot for joining in. Well, for the past year, you ended up with a revenue growth of close to around 25%. What are you targeting in 26%? And if you give us a broad breakup of this growth between your different businesses.
Sure. Good morning, and thanks for having me on the show. Just to kind of decode what happened in the fourth quarter, I think it kind of demonstrated the resilience of our model. Like indices, especially the large cap indices, fell almost 14 to 15% at the bottom in this 3-month period. If you see the results, our revenue went down only by about 4%, out of which you can think of about a 1.5% contraction coming because of business reasons, which is absolute volumes and business-related revenues, and about 2.5 to 3% adjustment because of a price adjustment that we were doing over a period of time for one of our large contracts. So it shows the resilience of the model, both the MFRTA business, the KRA business, and part of the payments business, not the whole of it, get impacted every time investor sentiment is down in the mutual funds and capital markets. So I think that's fantastic resilience. Last year was a great year. Like I said, we grew revenue by about 25%, profit by about 30%. In this year, I'm just cognizant of the fact that some of this price reduction that we had to do, about half of it has played out. The balance half has to play out over the rest of the year. So we don't give any forward-looking numbers. I think an overall revenue growth rate in the order of early teens is perhaps what you will see in FY26.
Okay. All right. Early teens. Got it. A couple of more aspects, sir, with regard to the profitability. You had mentioned in the past that we could be looking for some yield compression. Given that yield compression that we saw partly in the past quarter as well, will you be able to maintain margins in that mid-40s that you have been doing? And what are the levers you have to offset the impact of this yield compression?
So I'll give you the good news first. The good news is that in the non-MF businesses, we've grown in excess of 20% in the last 2 years. We're projecting about a 25% growth this year, which means wherever we have a platform functioning, I've already invested in the platform in sales and product, and any revenue that comes largely will flow to the bottom line. So non-MF has been a great story. Despite whatever happened, all the puts and takes, including the price in the fourth quarter, we are holding operating EBITDA at just short of 45%. Now, that's again a great testament to the resilience of the model. So again, my estimate is that in FY26, you will largely see one of the two numbers, either 43 or 44% operating EBITDA for the year. For the initial quarters, it may be more like slightly under 43, but we are almost confident for the year we should be able to return about 44%.
No, got that. In terms of the in terms of pricing from here, right? As you said, you took a price adjustment, Mr. Kathuria, with one of the customers. What would you have pricing leeway this year, or you think pricing perhaps moves the other way, a little bit under pressure as market environment, etc., remains a little uncertain, or it doesn't work like that? Just explain that to us, sir.
So the way it works is that in the digital era, the era of differentiated services is ending, which means that you will see almost a near uniform, I would not say uniform, but near uniform price across large clients. So I think that's the adjustment we made. In the non-digital era, till about 3 or 4 years back, we had some differentiated pricing that is going away. So you will see a small yield compression from here in FY26, largely led to this contract. Like I said, 50% of the adjustment we've taken in the fourth quarter, the balance will happen in the balance part of the year. But at an absolute level, we are confident that between 43 to 44% operating EBITDA should be delivered over the year in FY26.
So the non-MF business will grow at about 25%. On the MF business itself, Mr. Kumar, just give us some perspective. There's been a fair bit of debate on this whole SIP stoppage, etc., and whether eventually there's a fair amount of redemption pressure building up as well. What particularly are you anticipating on the MF business if the market continues to be range-bound?
I will just give you one headline. Read the collection numbers from SIPs, which grew in 4Q over 3Q and have successively grown over the quarters. Some attrition in SIPs has been a part of the marketplace for a very long time. A 40 to 50% first-year attrition is seen. But if you just watch what the collections have been, they've been extremely positive, and that's been a great sign. We believe the middle and bottom of the pyramid is holding this entire structure up. The Choti SIP and Jan Nivesh and those kind of things, as they get launched, will bring one brand new segment into the market. HNIs have not been holding up the MF market. So we are very positive that as the glue in the behavior of investors continues to demonstrate what it has demonstrated, they haven't panicked in the last 8 months and hopefully will not panic, you will see absolute growth from where we are.
What should we expect? If we talk about the revenue split, say by FY27, what will be the contribution of MF versus non-MF? And if you could give us some sense on margins on both these businesses as we look at the next 12 months.
The MF margins are in excess of 45%. The non-MF margins are in the range of 25 to 30%, which is a very good number. Remember that most of our businesses are of the order of a platform. So whether I take Account Aggregator, MF Central, Bima Central, all of those are typically platform businesses. So today, think of the margin split as in excess of 45 for MF, in the range of 25 for non-MF. Given the fact that most of them are platform businesses, most incremental revenue goes to the bottom line. So over a period of time by FY27, we believe that non-MF revenue contribution should be of the order of 17 to 18%. It's about 14% right now. It will continue expanding. And from a margins perspective, we see us recovering back to 45 and 46% in the next 2 years.
All right, Mr. Kumar, thank you very much for joining us and running us through all of that. Very, very useful information there.